Amit Goel, co-founder and Chief Global Strategist at Page 360, to discuss the terms of how stock markets are at this point of time. Namaste Amit ji, a very warm welcome. We are fortunate to have a very strong rally from the base of March all the way to August now as far as mid caps and small caps are concerned. Forget individual stocks, many of them who have gone up by 50-70%. It's the index itself which has surged remarkably. How are you reading sentiment at this point of time?
Thanks for a very warm welcome, Shell. So, yes, it's been last 4 months have been pretty good for the Indian and, of course, the global stock markets. And since our March and April beginning lows, we have seen we've seen a 30% plus move in small cap index, close to 30% in mid cap index. We've seen Nifty come up by about 3,200 points from the bottom, which is about 16 odd percent. So there's been a smart rally all this while. And globally, of course, we've seen massive rallies in US, in South Korea, in Japan, in Europe. So it's been across the board a great time, even though the Iran war has still not found its logical resolution. And it seems that it may take a few more weeks or maybe even a few months for that to be resolved. But till then, I think the markets are in fine fettle and they have sort of taken in their stride the unpredictability and the uncertainty on the geopolitical front.
Fair point. So, according to you, this is a dead cat bounce. It might be sharp, it might be swift. People may have made immense money in this rally, but eventually it will fizzle out.
I would not really define it as a dead cat bounce because Shell, dead cat bounce we usually reserve for times when markets are significantly off their highs, and then they just have a small retracement of the fall. But here, actually, the small cap and mid cap indices have made new all-time highs, and they have repeatedly done so over the last couple of months. So we've been making new all-time highs in small cap and mid cap index, and while of course Nifty and Bank Nifty, you can say that we are nowhere close to the highs which were made, and the highs were actually made just before the Iran war started. So in January, Nifty made its high, and in January, February, Bank Nifty also made its high. So yes, theoretically, you can call the move in Nifty and Bank Nifty from the bottom a dead cat bounce, but market overall has been in fine fettle, and particularly, as I mentioned, small and mid cap indices have been making new all-time highs.
Okay, so what's prompting the Nifty? What's preventing the Nifty from hitting an all-time high?
I think what has happened is that small caps and mid caps have gotten a lot of attention from market participants because the EPS growth there has been pretty good. It's been in double digits, and you can say ballpark the expected growth in EPS for this year is 20% plus for the small cap and mid cap categories, while for the Nifty as a whole, the EPS growth is projected only to be about 8%. So that's the reason from the fundamental side, but there are a lot of technical reasons as well. FIIs have been big sellers, and they are obviously big holders of banking, IT, and the rest of Nifty and Bank Nifty. So while they have turned buyers over the last 5 to 6 weeks, but in the overall picture, they have sold out a lot more than they have bought this year. And then, of course, IT index has also kept Nifty in check because IT index from the highs of Jan Feb, it is still down significantly. It's down more than 20%. While yes, from the bottom there has been a massive rally, but they are significantly off from their highs. So I think these are the reasons why large caps have not performed as an index, and small cap and mid caps have performed extremely well.
Okay, fair point. So, what's the structure as of now, Mr. Goel, for your own clients' portfolio and Page 360's prop account? What is the overall breakup of equity within equity? How much small cap? How many corporate bonds, precious metals? Let's just start with the top-down approach. How much of equity? How much of bonds? How much of precious metals?
Excellent question, Shell. So basically, equity we have pruned down significantly over the last few weeks. We have taken advantage of the rally that happened once FIIs turned buyers, and we have significantly pruned down our equity holdings. So now, let's say in our flagship Flexi and Privy schemes, the equity percentage is now close to 15%, and much of the rest is in corporate bonds. So while yes, precious metals do have a small percentage, but there also we would be booking profits pretty soon. So let's say broadly speaking, it's 15% equity and it's about 80% debt, which is corporate bonds, and rest of the 5% is in precious metals.
Fine. No cash.
No, no, absolutely no cash, because we use corporate bonds whenever we have surplus liquidity. So rather than putting it into liquid funds, which get a measly 5%, 5.5% return, we put the money into corporate bonds where our run rate is in double digits, definitely north of 10%.
Okay, fair point. So, within 15 in the equity universe, I know this is less than paltry. How is the structure?
Yes. So basically, we had a lot of money invested in Nifty and Bank Nifty. So
Okay.
Nifty we have now almost completely exited in the last couple of weeks when Nifty broke above 24,300. We just kept selling. So Nifty is practically down to zero. So this entire 15% is sort of majority in Bank Nifty, where we are still very positive because the earnings have been good, and the price earning ratio for Bank Nifty as a whole is somewhere between 13 and 14. So we believe that if the markets rebound and if the markets go up more, then Bank Nifty should, from these levels, outperform Nifty. And we have some bit in small caps, but then that is not individual stocks. It is small cap index, which has been doing rather well. But we would be looking to book profits there as well over the next couple of weeks.
Okay, so I'm presuming the Bank Nifty is the ETF.
Yes, absolutely right. It is the Bank Nifty ETF.
Okay, and the small cap ETF, which one are you talking about?
It's I would not know the exact ETF which we are holding, but it is basically the base index is the BSE small cap index. So
There are
our
many, 50, 100, 400, there's so many indices. That's why I
uh,
ask.
this is the broad-based one. I think it has got about 400 stocks.
Yeah, yeah,
Uh,
yeah.
Yeah. So, and this is not a very significant holding at the scheme level, but yes, we did buy it. When markets were down in June, and we've been holding it ever since. But I think it has rallied now substantially over the last few weeks, and we would be looking to book profits there as well.
Yeah, there is absolutely no doubt in my mind that it's rallied fantastically. There seems to be one ETF which is Mirai Asset Nifty Mid Small Cap 400 Momentum Quality 100 ETF. So out of 400, there is a collection of 100 stocks, be that as it may, we'll check it later. It's just that your exposure is 15%, of which Bank Nifty is a larger percentage. Fine.
Much larger percentage.
Now, why so much of emphasis on corporate bonds? What are you fearing?
So basically, Shell, we have been pretty tactically bullish on the market since April, and I've got the opportunity to be on your show a couple of times, and we have always been bullish, but it was basically a tactical positioning and not a long-term call. And we are not long-term bullish at all at this point, and neither were we long-term bullish when we were actually buying equity in April and May. It was just a tactical call, and we are of the opinion that once this particular boom in the global stock markets and the global economy sort of phases itself out, then the long-term scenario for the whole world economy is pretty bleak. So we definitely believe that we are headed for a very severe recession over the next couple of years. In fact, there is a pretty wider path now for that severe recession to become a severe economic depression. And we have, in fact, called it the greatest economic depression. That is how serious it could become. So it will, of course, start with a slowdown. And right now, there is no slowdown. Right now, things are looking pretty good on the economic front. But you know that markets are forward looking. So once the markets come to believe in their collective wisdom that the global economy is now going to hit a soft patch, then markets are going to sell off. Which is why we are now selling out a lot of our holdings in India, and our global funds are also liquidating their long-term holdings in US and other places. The idea is that we should be one step ahead of the market. We should book our profits. We should go into the safety of safe havens before the big fall comes. And this could be a pretty severe recession or a depression which may unfold. So I think definitely the worst in last 90 years. But if our greatest economic depression theory, if that stands, then this could be the most severe economic crisis ever in the history of capitalism.
And that's because we are headed for a slowdown, you say. I mean,
Uh, it,
basically, the slowdown is accelerating.
so basically, the sheer magnitude of the economic bubbles that we see around us is unprecedented. So this is like the tech bubble of 99 2000 raised to the power some 10, because the size of the bubble is much bigger than the tech bubble. And when the tech bubble burst, the emerging markets were literally at bare bone levels. Real estate was at very, very low
Yes.
levels all over the world. So this time, the size of the bubble is much, much bigger than what it was in 99 2000. There is a real estate bubble. There is an across asset classes bubble. The valuations are pretty rich. And you know the kind of circular stuff which is happening in US AI. When US goes into a recession, it will have its impact all over the world. So this has got shades of 2000, it has got shades of 2008, and it has got shades of 1929, all happening at the same time, which is why we believe that the slowdown, it would always start with a slowdown, but it would snowball into a recession, which would snowball into a severe recession, which could then snowball into the greatest economic depression of all times. And this is the first time that we are airing it in public. We have sort of known this in our minds and hearts for quite some time, but we believe that the time has come that we at least start airing this, even though I do not believe that the sharp fall in the equity markets is going to happen anytime soon. This could be 2 months from now, it could be 6 months from now. But the direction is pretty clear. The exact time frame I'm not able to clearly know, and for that matter, I don't think anybody in the world would know. But yes, sometime in the next 2 to 6 months, this fall would happen, and then within a few months post the fall, you would see the global economy getting into a recession.
Okay, so what does one do to safeguard his or her wealth as far as the potential of this incoming recession is concerned?
So obviously there are some asset classes which are going to do pretty badly, and equities unfortunately is one of them. So you can assume that globally the stock market MCAP, which is now close to about 140 $145 trillion, you can assume that if our predictions come true, then we would see a fall of minimum 60 to 70% in the global MCAP. And I don't think India would be an exception this time. So equities, obviously, one would have to steer clear from. And corporate bonds is also something at that point which one should be a little concerned, unless and until you've got absolutely the AAA corporate bonds. The one asset class which is going to do extremely well is the sovereign bonds, which have done extremely badly over the last few years. So whether it is the Indian 30-year bond, which is trading at about 7.41% right now, or the US 30-year bonds, or the UK 30-year bonds, the Japanese 30-year bonds, they will do extremely well. And equities will go down, commodities will go down, precious metals in the first phase of the crisis will go down, and corporate bonds may not do well. The bond spreads, the yield spreads on corporate bonds will do badly. The high yield bonds will do badly. The private credit is going to be a very, very big problem for a lot of people. Commercial real estate, not it will not do well. Residential real estate will also sell off. But fertile farmlands will do very, very well over the next 5 to 10 years. So there are a few asset classes which can sort of, which could withstand the tsunami that may be ahead of us. But I must caution at this point, we should not jump the gun. And this may be 2 to 6 months down the line, the big fall in the equities. So till then, we would have to navigate it very deftly. But taking a long-term call on equities at this point is not advisable at all. You can take tactical calls. You can make money over the next 2 months, 6 months, or whatever it takes. And then, but eventually, one would have to go into sovereign bonds.
So, sovereign bonds, the bond prices will also, you feel, rally very sharply. The yields may go down. That's a correlation. Inverse.
Absolutely. So the bond yields will go down because there is going to be a lot of safe haven flows into government bonds. So I believe that the Indian 30-year bond yield right now it is 7.4%. I would not be surprised to see it at 5% within the next 2 years. And US, Japan, and UK will see even more handsome appreciation in the long-term bonds. So that's an asset class which could deliver something like a 40-50% return over the next couple of years, which is a very equity-like return, which you will probably get from sovereign bonds. But then the same thing happened in 2008 when equities went down by 60% in India and 55% in US. But the sovereign long-term bonds, they gave returns of anything from 40 to 60% in 2008-9.
Fair point. So, within the Indian universe, how does one buy into this 30-year bond? I presume the shorter tenure will do equally well, 10-year too? 10-year yield is not too far off from 7.1.
You are absolutely right that the 10-year yields would do, 10-year yields would go down. Right now, the 10-year yield in India is somewhere between 6.7 and 6.75. they will go down. But the only thing is that the shorter the duration of the bonds, lower is the multiple. So on a 30-year bond, for a 1% fall in the yield, you would make 17% or thereabouts of capital gain. While in case of a 10-year bond, a 1% fall in yields will only give you a 7% capital gain. So not only is your YTM much lower in 10-year bonds, it's lower by about 70 basis points, but your capital gain is also going to be about half of what you will get in a 30-year bond, which is why we recommend 30-year bonds and not the 10-year bonds.
Okay. Is this a market which is open to the Indian retail investor?
It is. So you could buy it through, you could buy the bonds directly, or if you are a investor who's looking to invest, let's say tens of thousands or a few lakhs, there are ETFs and mutual funds in the Indian context, which will give you that ride without you having to buy the bonds directly. So this is something which every single investor in the country can do, irrespective of how much money you have to invest.
Right. We'll pause it here, Amit ji, on this very somber note of an impending, as you rightly, as you put it, an economic depression. I've written this down with your date and your name, with today's date and your name against it. Not that we will hold it against you, but one must be at least mentally aware of the possibilities of a very sharp downturn. It may or may not happen, but if it does, it's good. And even if it does not happen, a bond cushion to your equity portfolio is always a good thing.
Absolutely, Shail. I completely agree with you. I think you summarized it beautifully.
Thank you very much, and we will be meeting shortly.
Thank you so much, Shail. Thank you.
Ladies and gentlemen, Mr. Amit Goel, founder and CIO at Pace 360, a very, very well-known PMS working out of Delhi.